뉴욕나우. 안녕하세요. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우. 오늘은 존 메이어 글로벌X CIO와의 인터뷰를 준비했습니다. 글로벌X는 미국에서 빠르게 성장하고 있는 ETF 운용사입니다. 뉴욕나우에서도 여러 번 만나보신 적이 있어서 이제는 잘 아실 거라고 생각하는데요. 오늘은 이 회사에서 투자 관련 최고 책임자인 메이어 CIO에게 내년 시장 전망을 들어보려고 합니다. 내년에도 미국 주식시장은 계속 오를 수 있을까요? 오른다면 S&P 500 지수는 얼마나 오를까요? 주식시장에서 가장 조심해야 할 리스크는 또 뭐가 있을까요? 여기에 현재 시장에서 관심을 끌고 있는 인플레이션, 금리 인상에 대해서까지 이야기 나눠보겠습니다.
Thanks for having me. I'm John Mayer. I'm the Chief Investment Officer at GlobalX. GlobalX is an ETF provider based in New York City in the USA. Well, right now, the market is contending with a bunch of different issues. Currently, many of us are hearing about inflation. The inflation story has been driven by demand. There's been a tremendous amount of demand owing to the unique circumstances surrounding the pandemic. As we know, the global economy was shut down because of COVID-19. When things began to reopen, a lot of people wanted a lot of things. It was a unique situation because never in history has a global economy been shut down. Also, there was just a tremendous amount of liquidity that was provided by central banks around the world, particularly in developed markets. The U.S. was the most dovish Fed, central bank around the world, providing a tremendous amount of liquidity and extra support during the shutdown. When things restarted, many different people had a good amount of money, whether it be corporations or individuals. So right now in the U.S., there's approximately $3.8 trillion that are sitting in cash that can help support the overall market. That being said, this potentially could provide some support during periods of market pullback that may occur next year. There certainly is the transitory story regarding inflation, but it seems as though it's becoming more perpetual. So I use the term perpetually transitory. So certain items are certainly going to come down in price. Used car prices are not going to increase 10% a month forever. Just not going to happen. There are other items that potentially could be stickier because of higher input costs like energy. Food costs are rising. Perhaps they stay a little bit higher. So in the U.S., CPI numbers came in at 6%. If you strip out some of the more volatile items like food and energy, the number is a lot lower. I do think inflation will be elevated, but certainly not at the 6 or 7% range. You may get a month of 7%. I don't think that's unrealistic. But when the supply-demand imbalance works itself out, things will pull back, which I expect sometime in the middle of 2022. So the Fed has indicated that they're going to taper about $15 billion a month, $10 billion of treasuries and $5 billion of mortgage-backed securities. That was for November and December. They haven't given any explicit guidance for the following months after December. But if you go on approximately $15 billion a month, that would bring the tapering to about June. I don't believe the Fed's going to move any faster. I believe the Fed is going to continue on its dovish stance, continue to overshoot its target of 2% on inflation, which we will overshoot on that for sure. At such time, which is approximately June of 2022, it's possible that the Fed may begin raising rates. The market is pricing in about 3 Fed increases next year, about 72 basis points. Well, I think we're in a unique situation, and that situation is that the inflation that we're seeing is driven by demand. and it's not necessarily driven by the increase in money supply. So oftentimes you'll see inflation as a result of banks lending more, putting more money into the system. That hasn't been the case this situation. The inflation is unique to the circumstances of the pandemic, shutting down the economy, restarting the economy. So it's not a typical situation. And the question remains, will the Fed increasing short-term rates, will that slow down the economy? Because it doesn't necessarily solve the issue of supply and demand. I think it'll certainly be an influencing factor. And what I'm hoping is that the Fed doesn't overreact and raise rates too much. Now, if Jay Powell continues to be the Fed chair, and that's not 100% certain, President Joe Biden potentially could nominate somebody else as Fed chair in the coming weeks. I think it's likely that Jay Powell will continue on as Fed chair, but he's been pretty dovish and letting the economy run with a lot of liquidity provided by the central bank. Unless the data changes meaningfully, unless the inflation numbers are a lot even worse than we expect, I don't think you'll see more than 3 hikes in 2022. So just kind of looking at the tech sector and the relationship to interest rates, it is a sector that is historically sensitive to movements in rates. So if you get a sharp move up in rates, the market inevitably, from a broad-based perspective, will go down. Will it go down for an extended period of time? That's the question. There's a couple things at play. First, I mentioned earlier that there's a tremendous amount of money on the sidelines. And second, people love tech. Third, the consumer is very strong. And tech companies are also able to pass on additional input costs to the consumer. So if raw material costs are higher, likely in the current environment, those costs can be passed on to the consumer. So margins will not necessarily be compressed for some of these larger tech companies. And that's a positive. That could help support stock prices. The second is that this large amount of money on the sidelines seems to want to buy the dips. Technology is pervasive and important, and even more so post-pandemic. You think about what occurred during the pandemic, we all worked from home. We were reliant on the cloud. We were reliant on financial technology. We were reliant on cybersecurity to protect our data because we're putting it all up in the cloud. Now, spending by corporations and individuals is not going to subside. It's only going to increase as long as revenues go up. I mean, that's a positive for these tech companies. Tech companies do tend to borrow on a broad base, if you're looking at the entire universe, and their cost of capital could go up. But if they can pass on those costs, may not necessarily hurt them from a earnings standpoint. So I'm still positive. I'm pretty bullish on tech because of the unique circumstances surrounding our current environment. Inflation is certainly something that I've talked about during this interview, and I think that it's going to be top of mind for many investors. What I think what we need to look out for is, when do the supply chain issues subside? When do some of the input costs go down? And I think that towards the middle of 2022, May or June of next year, we should see some of the supply imbalances work themselves out and some of the inflationary concerns subside. If they don't, then that potentially could increase actions by the Federal Reserve to combat inflation if that occurs. Inflation is a concern, supply chains are a concern, but I think some of that's going to ease up in the middle of next year, middle of 2022. Sure. China is a very important market. It's the second largest economy in the world. It's a very different economy than the U.S. economy. Now, over the past about 2 years at this point, they pretty much have closed off their borders, and they've been a little more insular. President Xi of China hasn't left the country in 2 years. And obviously we know because of the pandemic, but it looks like they're looking a little more inward. Now, the difference in the systems in the U.S. or in the West versus China are stark. Take, for example, if we want to regulate big tech in the U.S. or in some of the Western economies, you would have to go through an an extensive legislative process. There would be lobbyists involved. There would be people for it, people against it, and the process would take a very long time to actually execute new regulations. Contrast that with China. Look what's happened more recently. China has instituted regulations, kind of changing the game for big tech, trying to make the system more fair for some of the smaller companies versus the larger companies, where it holds all the data and it holds all the leverage, and changing some of the regulations that would foster innovation for some of the smaller companies. Seems logical, seems like a good thing, but it changed the game on investors rather quickly. So you asked about, isn't China investable? Sure, it's investable, but there's less certainty. Now, investors like certainty, and they have a little bit less of that right now. There's some other unique issues going on in China as well. First, growth has slowed meaningfully in China. GDP estimates are about 4% for next year, which is very low for China. Also, there's some concerns about the property market in China. And what you're seeing by the Chinese government is that it's a little bit hands-off for them. They're letting the market run and trying to see where it lands. I don't think that they're going to let the real estate market fail, but I believe they want to let it see what happens on its own for a period of time. They will step in if necessary. And I also do wonder whether President Xi, what type of advice he is receiving, and is it the right advice? From my perspective, some of it seems a bit misguided. I still think it's investable, but it's, as I mentioned, investors like certainty, and there's a little less certainty with China. China is an important market, whether it be investing into China or the supply chains related to China. The concerns about higher tariffs or reshoring supply chains back to more local markets, that takes a long time to execute. But the Chinese market is important, and there's ingrained supply chains that are already embedded. Whether that changes in the future, it takes a while to change that. And then you have this massive amount of people that are moving from more rural environments to cities, wanting many different goods and fueling the consumption story.
Okay, then do you recommend one?
I do believe that it's riskier right now because the uncertainty related to China and changing the game, changing the rules whenever they choose to. I think some of the most notable industries this year include robotics and artificial intelligence. It's an area that it's going to be ever more important going forward. During the pandemic, robotic technology, it became apparent that it was really important because of contactless exposure. We wanted less exposure with other people because of the virus. Now, once the economies have started, we've noticed that there's certain people don't want to go back to work or don't want to do what they did previously. So we are seeing shortages in the labor market in many different areas. And many different companies have demographic concerns with regards to satisfying in certain industries with enough employees. Robotic technology can fill the gap in certain areas. So I think that's a very important theme and it will play out over many decades. Another area, just kind of a broad, that it's hard not to be not exposed to, is sustainability or sustainable investing. In the US, there's an infrastructure bill that was recently passed that provides some amount of money for combating climate change. There's another bill that's proposed in the US through the budget reconciliation process that, if passed, will provide approximately $500 billion to help combat climate change. And that will propel many different industries, including electric vehicles, solar, and wind. And corporations are going to place a keen eye on trying to emit less carbon. Because at some point, we have to rely less on fossil fuels because that's really the only way to mitigate this situation. So sustainability more broadly, robotics and artificial intelligence are very important areas. Now, the theme that I think that we should really pay close attention to in 2022 would be cybersecurity. It became very apparent through the pandemic that we were putting a lot of data up in the cloud, and we were exposing governments corporations and individuals to risks. Cybersecurity is an area that spending will increase. Most corporations are indicating that they have to increase their spending in this area. Most individuals have to do the same, as well as governments. So I see a tremendous amount of spending in this area going forward, and it's a theme that I believe we should all pay close attention to in 2022. Sure, the cryptocurrency landscape or blockchain technology is very interesting. Right now, the market is coming out with Bitcoin futures ETFs in the US. There's other countries where there are actually Bitcoin ETFs based on the physical Bitcoin, physical in a sense because it's not quite physical. The blockchain technology, I think, is very important. It's a ledger system. It's a record-keeping system that is going to be relevant to many different businesses. Now, there's a lot to unpack with talking about blockchain and cryptocurrencies because there's different kind of cryptos. There's Bitcoin, which is more of a store of value. There's Ethereum, which is decentralized, and many other coins are being built off the Ethereum platform. And so there's many different use cases besides just potentially some sort of digital payments. There's potentially art, video games, Airbnb can use it, the metaverse with Facebook and options to use cryptocurrencies, tokens in the metaverse. So it's a broad-based system that's just developing. It's early stages. And what you're seeing is that it's being integrated into financial technology. And that's so interesting. And I believe it's going to potentially really change the asset management business, potentially changing the banking business. It's an ecosystem that is growing fast. And it's an area that we should all pay attention to. I have a view that it's important, that it's volatile. So it's not for everybody in terms of buying, whether you buy certain tokens or you buy mining companies through just a blockchain exposure. But you have to expect volatility. Again, it's early stages. Just today, you saw Bitcoin go down, 7 to 10%. Some take that as a buying opportunity. Some get nervous. There's a lot of leverage in the system, and I believe that's one of the reasons you see such large swings in prices in such a short period of time. And that's not likely to go away anytime soon. But you are seeing larger corporations put Bitcoin, which is a store of value, on their balance sheet, which is, I think, an important next step. And previous naysayers of Bitcoin and blockchain technology seem to be coming around saying it's going to be something. Not sure exactly what it's going to be, but we do know that it's probably going to be hard to regulate. Also, don't necessarily believe it's going to be a currency per se, but it's some store of value, but it's volatile. The positive aspects that we have right now is we have a strong consumer, we have a very healthy housing market, we have a tremendous amount of savings, and we have a dovish Fed. I believe the Fed will be less accommodative going forward, but I still believe that there'll be a large amount of interest in the market. Another reason is that interest rates are so low. Even if they move up some, where are people going to put their money? Are they going to put it in a bank account? And with inflation, they'll be losing money. They'll put into some bonds that will lose value because interest rates are rising. So I think there'll still be an interest in the stock market more broadly. Putting an exact number for fun, I'll say between 8 and 12% for next year. 8 to 12% returns for the S&P 500 in 2022. So typically in December, we get something called a Santa rally. Going back to 1928, the S&P 500 has returned about 1.3% in December on average. Certainly some years they've gone down. The market's gone down, certainly some months, some Decembers it has gone up more. But on average, about 1.3%. Also, people come back from the holidays, they're rejuvenated. January typically is a pretty good month as well. So I think potentially we'll have a pretty good first half of next year. And then returns will moderate as interest rates rise towards the second half of the year. I was speaking more broadly. Overall, I think the market's going to be a lot more selective going forward. And a lot of the returns we've experienced over the past several years has been liquidity driven. I think we have to look at fundamentals. We have to look at individual companies and how they're doing, how what their input costs are, how their sales are, what their earnings are on an individual basis or kind of a theme sector level. I do believe that dividend-paying stocks are going to be an area that's of importance, particularly dividend growers, companies that can actually grow their dividend because interest rates are still historically low.